Cremé Wealth Management, we come with no pretense. Financial advising, making money make sense.
Okay, we're going to kick it off. As we go through the slides and come upon things, if you have any questions, feel free to put a question in the Q&A box that you can do through Zoom, or you can also text me a question too, and I'll be happy to answer that as well. So we're going to go through and talk about tax law changes that are being kind of talked about, some that are being proposed right now, and look at it in light of what tax law has been in this country historically, so we can see how it plays together with history and how we can kind of see the future going as well. So there we go. So the scary reality is that, as Ron Swanson would say, there is only one bad word, and that word is taxes. So no one likes taxes. We all want to figure out, how do we pay less? How do we get around this? And there's some things we can do to plan, and some things we just need to know, hey, here's the situation, and let's look at this reality. So just like how we approach everything that's scary, whether it's election cycles, down markets, what we're going to do is to take the approach we always do, is we approach scary things by shining a light on it and trying to be the light in the situation. So that way we can focus on the things we can change and not worry about the stuff that we can't. So Dave Ramsey has a great quote that I like a lot. It says, "Goals without action are just dreams." And I would almost take it one step further and say that fears without action are just nightmares as well. So a lot of times we're very afraid of what's going to happen. And if we can see, hey, here's what's going to happen, let's put an action plan around it, it helps to alleviate those fears in our lives. So that's my goal in going through this, is saying, this may be a current fear of yours. Let's approach it in a way that helps alleviate that fear and stress from your life, hopefully a little bit. So starting off, we're looking at the federal revenue, tax revenue. When we talk about taxes and taxes being raised, we need to see, hey, where does the government get their money from right now? And is this being changed? Is this kind of the way it is normally? So what we see here is about 50% of the government revenue, the big chunk, is in individual income taxes. So that's after you generate your wage, comes through, that's the individual income tax portion. Next largest area of federal tax revenue is payroll tax. So down here in the 36% here. Payroll taxes are, Social Security, Medicare, half that's paid by the employer, half that's paid by you as an employee, or if you're lucky enough to be self-employed, it's both sides of the coin. So that's 36%. The next largest is in the green here, corporate income tax at 7%. And corporate income tax is going to be, specifically, we'll talk about this a little bit, C Corps. So that's the corporations that have a corporate income tax. And then we have a few other smaller ones, where the bigger ones we're going to talk about are this excise tax, which is sales tax, basically. And then other, which would also encompass estate tax or death tax, which is another thing that's being very highly discussed right now. So as we go through that, we're going to say, well, how has this revenue been historically? So how we can look at this chart is saying, from 1945 to 2018, how have these taxes changed and where the revenue comes from for the government? So we have, starting here, this dark blue is the individual income tax portion on the bottom. So all the way in 1945, it was about 40%. And as we saw now, it's closer to 50% for individual income tax. And corporate income tax was somewhere less than 40%. So maybe about 37% was corporate income tax, where now much lower. And the one that's expanded the most is payroll tax. So payroll tax up here at this 36% or so portion was only a very small portion in 1945. And excise tax, estate taxes and whatnot were about 20%, and they're less than half of that now. So this is a neat snapshot, but what is interesting is since 1945 to 2018, there really haven't been any monumental kind of paradigm shift legislation that's come through to change tax law. Yes, we had the Tax Cut and Jobs Act in 2017, which did help significantly, but nothing major. So I'm talking about major overhaul of this country. So if you actually go back further, here's the federal revenue percent by tax category all the way back to 1934. And there you can see a much bigger shift. So this here was actually when the payroll tax came onto the scene. So this was some of the New Deal. Social Security gets put into place. Before that, you can see excise taxes here made up for about 40% of national revenue. So hence the stamp tax, all those things, you pay taxes on what you purchase. That's how taxes were, started. And income tax is very low. It actually started about 13%. And then things changed, right? The New Deal monumentally changed things in this country, infrastructure, changes across the board, and that can make a huge difference. And that's what I want to illustrate in this chart here, just saying the last one was great. It shows how the shifts have happened, but this one is saying, hey, what if a whole new category kind of comes onto the scene? So payroll taxes started here in the late 30s. They actually became a fairly small percent of federal revenue, but has since very much expanded as people's lifetimes have continued to grow, since Social Security was really only designed when the average point of death was around 67. So when it was going to start at 65, it was kind of seen as something that wasn't going to be used, which turns out really isn't the case anymore. So income tax has been somewhere around 45 to 50% of the revenue pretty consistently. Corporate taxes have come down pretty well during this time. And excise taxes also have come down the most, from this 40% back in the 30s down to only about 3% of corporate or federal revenue for the government presently. So I want to go through each of these categories and just say, hey, here's what it is. Here's what the government's kind of talking about, what they're saying in the news and what's been proposed now in the Senate. So we can see, what's likely to change. And then I hope to do kind of a follow-up if any, law actually gets put into place to talk about the specifics of what to do. So excise taxes, this is that smallest portion. It's about 3% of federal receipts in 2019, so about 3% of the operating budget. And this is sales tax on purchases for fuel, alcohol, tobacco. Airport and Airway Trust Fund, I thought was interesting, had its own slice that's put in there. And the ACA, the Accountable Care Act. That portion was repealed, but I just like to make the point that it can be added on. Taxes can be added on to the excise part in the federal tax. The tax that you see when you get your receipt, like here in this picture that says, hey, your tax rate was, in this case, 6.35%. This is mostly sales tax that's state driven. So a lot of the federal stuff is going to be behind the scenes. It's going to just make fuel prices not be $2.85, but $3.15 because there's 30-cent tax kind of built in per gallon. So that's how the federal excise taxes kind of operate. The next category is estate and gift taxes. So again, only less than 5% of federal revenue. And what we're talking about here is we have, because of the Tax Cut and Jobs Act, $11.7 million per person federal tax exemption, a lifetime exemption. It was doubled in the Tax Cut and Jobs Act. And in 2026, it's already slotted to go back to what it was, which is half of it. So you can think of it as it's already going to be 11.7 million, not per person, but per couple. And what's being discussed, and we'll get into this later on a lot, is saying what should be taxed upon people's death. So this is all money that has already been taxed. You've already paid payroll tax. You already paid income tax. You might have even paid some capital gains tax along the way. And then when you die, is there another tax that should be assessed? So this is really kind of the death tax portion that we're going to talk about and say, what are they looking to do for this portion? Corporate income taxes. So this is 7% of the federal revenue. Again, it's C Corp specifically, because sole proprietors, LLC, S Corps are all pass-through entities, which means that the income tax portion is really more applicable for running those businesses. But if you run a C Corp, you see here on the right-hand side, starting back in 1918, it shows the tax rate for corporations as high as the low 50s here. Most recently, it was 35%, and the Tax Cut and Jobs Act cut that to 21% to try to make the U.S. a little bit more competitive worldwide, since nationally, I believe the number's close. Internationally, I believe the number is closer to 25 or 26%, according to some articles I read. So this is really applying to about 5.6% of all U.S. companies. So we're not talking about the vast majority of people that it's going to apply to, but this is talking about those really big companies. These are the Fortune 500 companies. It used to be if you weren't over a certain limit, you would never consider a C Corp, because they do cost more to upkeep and have a little bit more burdens when it comes to record keeping. So it's a small percentage of companies in the U.S. However, it is a large dollar amount of revenue that it's applying to. So this is likely an area that will be changed in future tax proposals. So also in 2026, when the Tax Cut and Jobs Act reverts, this 21% was already going to be going back to 35 unless the Senate and the House kind of ratified that and kept it in place. Payroll tax. So this is that 36% portion of the pie chart. This is specifically Social Security, Medicare Part A, unemployment insurance for the corporate side. 12.4% Social Security tax is assessed on the first $142,800 of income. This dollar amount is indexed, so it goes up. So it just includes more and more of your income that's included. Of this 12.4%, now we pay as employees half of this, and the employer pays the other half. Then if your income is $200,000, you pay it on the first $142,000, and then you don't pay it after that. So when you're growing in your income, you might hit a point where you say, hey, it feels like I got a raise. Well, no, what happened was you stopped having to pay the 6% Social Security tax. Now, add on top of that 2.9% Medicare tax on all income. There's no limit on that dollar amount. And then a 0.9% Medicare tax additionally on all income over these dollar limits down here, depending on your tax filing status. So this is also an area that is likely to be changed or augmented in the future, and we'll talk about that as well. But this is kind of what we're talking about when we say payroll taxes: Social Security, Medicare, unemployment, things of that nature. And this kind of breaks down how it looks behind the scenes and how it's looked historically. So from 1937 on, you had Social Security put into place. Medicare was part of that. And then over time, the Social Security percentage has been basically ratcheted up each year, as including a higher percent of the income. And then in 1965, Medicare became its own percentage, which is where we get this purple line from. So it's adding the blue and the red. So this is changing the percentages of what is being charged. In the green behind the scenes is the taxable wage base. So this is that 142,000 that I was just saying is the current number of how much is taxed. And then the lines are the percentages as that has gone up. So what this shows you is that really since, right about 1990, the Social Security Medicare percentage has not changed. So it's still that 15% or so of your total income. However, this wage base is going up. So this is how it's been taxed more and more, is just by being historically more inclusive of how much of your wage it's going to be applicable for. And then we have income taxes. So this is the biggest revenue item for the government, 50% of all federal receipts in 2019. This is all taxable income. So this includes your wages, includes pension income, includes up to 85% of Social Security income. And on top of that, we have ordinary income and we have capital gains income. Capital gains income, it's also taxable for. So this is stuff that you've already paid taxes on, and now you're paying taxes again on the growth. So this would be like a taxable stock account or mutual fund account. Real estate would also be held, in this category. And keep in mind that ordinary income and capital gains income are two different tax brackets. So again, this is something that's likely to be changed in the future. But just to illustrate these different tax brackets, we want to go back to all the way 1913. Ordinary income kind of came onto the scenes, and you see how low it started and then jumped up. We're fighting a world war. That was to fund the war. Came back down and then again pushed back up all the way to about 93% in 1942-43 was the highest marginal tax rate. So it's not all of your income's taxed at, but the highest earners were taxed at. And then you see how it's kind of come down over time to a relatively low number for tax brackets, when you look historically. So this is your ordinary income. This is kind of the first pass of income tax. Now, capital gains is in the red, and the capital gains rate is the taxes that you pay on basically things you've already paid taxes on. So you'll see here that these are two different rates, and the capital gains rate also has gone up and down a little bit, not as much as ordinary income. And there's even a point here around 1990 where they were the same. So there's precedence to say, hey, they don't need to be different. They can be the same as one another. But right now, what we're seeing is about 20% plus a Medicare or Obamacare surcharge, about 3% on top of that. So 23% versus, around 40%, 37% for ordinary income. So there's a pretty good gap in between them currently. Now, will that change in the future? Maybe we'll talk about that. So these are the main categories that I just went through of federal income tax. So what is being discussed, what's kind of on the table for these different categories? So number one category, smallest revenue for the federal government, is excise taxes. So this is, again, like sales taxes, basically. Really, we're going to call this warning level low. Not really being discussed. It's not a high agenda item because this is taxes on the majority of people, which is not very popular. So I don't think it's going to be something that changes in the meantime, but what's scary about this is how all those taxes are totally behind the scenes, and it just purely raises the price of things without being very transparent on how much is truly the cost of fuel and how much is the government raising those prices through taxes. Estate and gift taxes. This one is right now 5% of federal receipts. We're going to give this a warning level high category. This is one of those ones that is pretty significant in what's being proposed and talked about. So what are some of those discussed changes? So annual gifts right now over $15,000 per person, you have to file paperwork for your annual lifetime gift exclusion. If you want just the annual exclusion, you can give a gift to whoever you want, $15,000 per person. No problem, no issue, no taxes need to be paid by you or them. But that is being discussed to move that down to $10,000 per person instead of 15. On top of that, the estate, the federal tax exemption of $11 million per person at death is being looked at to reduce it. Remember, it's already going to go back in half. So in 2026, it was already going to go to 5.8% or so, or 5.8 million. Now what they're looking at is saying, let's drop it all the way to 3.5 million. So $3.5 million per person is the number that's kind of being talked about. But there's also a lot of discussion around basis. So that's the last point here is a full step up in basis versus a carryover basis or recognition of all capital gains upon death. So what do these things mean? So basically, right now, if you were to pass away, you would get a full step up in basis for your estate where you hand it to your kid. I think I've got some examples here actually right here. So if you paid $150,000 for stocks when you die, it's now valued at $600,000. You gift it to your daughter. She right now pays nothing. So as long as your estate is under this number, whether it's 3.5 million per person or 11.7, as long as it's under this part here means your heirs don't have to pay taxes on that gift that they're receiving. It's called a full step up in basis or cost basis. Carryover basis is kind of the intermediate zone. Carryover basis means when you pass away, whoever inherits that stock or that real estate, which also is in this category, they would have to pay $450,000 on that growth. So it went from 150 to 600. The difference is 450,000. That's the growth in the account. When they sell it, whether it's all at once or piecemeal, if it's not just a real estate holding, then they could basically realize those gains as they sell it and pay the taxes over time. So that's kind of option 2 is called carryover basis. Option 3 is full basis recognition upon death. This one to me is the scariest. So this is, in this example, you had $150,000 of stock. It's now $600,000. You pass away, you give it to your daughter, and it was a stock that you worked at all your life for an oil company. Well, immediately when you pass away, your daughter would owe taxes on $450,000, which may be, as high as 30-40% of that. So basically they could get a $160,000 tax bill due immediately. And unless they had that cash in the bank sitting on the side, they would be forced to liquidate the stock or liquidate the real estate holding to pay for the taxes on it. So that's what the full basis recognition is all about. And there is talk to copy Canada in this, which is basically eliminating this exclusion and saying we're not going to have a federal, tax exclusion, but we're going to basically make sure everything is valued and taxed when someone passes away. So that's what's being kind of discussed right now. Corporate income taxes. So this is, again, we're talking about C Corps specifically, 7% of federal receipts. So 7% of revenue comes from this. Currently, it's at 21%. It was cut from 35. There's proposals to raise it to 28%. So kind of split the difference a little bit and have a 15% minimum. That's the interesting addition to me, is they're saying, hey, we're tired of seeing in the news these companies and CEOs saying, I pay less in taxes than all of my employees because of tax law. So what they're going to do is they're say, fine, if your company makes over $100 million, you have a minimum of 15% that we're going to tax you regardless of your accounting. So it'll be interesting to see what happens there. The scary thing about corporate income tax and changing all that is that companies are not required to stay, domiciled in the U.S. They could change their location to a country that's a little bit more favorable. So you're always playing a little bit of a cat and mouse game, I feel like, in changing corporate income tax rates, because if you change it enough, you're just going to scare them away. Your revenue is going to go to 0 instead of 7%. So I'm going to say this is a warning level moderate category. It's not going to affect a lot of us, and even business owners that are smaller business owners to mid-size owners. A lot of times they're not C Corps. So again, it might not change. This is, however, one of the areas that could, in my opinion, impact the stock market the most. So a lot of this isn't actually going to impact the market more than likely, but this area could potentially on how it affects corporate valuations. So payroll taxes, this is 36% of federal receipts in 2019. Again, we talked about 12.4% to Social Security plus the 2.9 and 0.9 if you're over the certain income level. The main change that they're talking about here is this right here. The first 142,000, and on top of that, having Social Security taxable on all income over 400,000. So basically, if you're familiar with Medicare Part D donut hole, that's what they're doing here, is proposing a Medicare or a Social Security donut hole when it comes to the taxation. So you'll get taxed on the first $142,000. And then if you make over $400,000, again, this 12.4% tax comes back. So you get a little bit of a hiatus from 142 to 400, and then it comes back with a vengeance. So this is a pretty meaningful difference here, especially because anyone that has uneven income could be impacted by this. So if you're used to making 200,000 a year, but 1 year you might only make 50, and the next year you make 600 because you're in a commissionable environment or something like that, this could impact you as well as people that make it consistently. So this is the main thing that's being discussed on the payroll tax side. And then income tax. So income tax, about 50% of revenue. They're talking about increasing the top rates. So if you make over $400,000, increasing it to 39.6%. Now, this isn't that different than where it was before. 39.6 was the previous top of the bracket. It would revert back there anyway in 2026 after Tax Cut and Jobs Act reverts back to previous tax law. But it is pushing it down a little bit more, because 400,000 would not actually be in the highest bracket. You might actually only be in a 32% bracket if you're married filing jointly. So that could be a pretty good push on top of the Social Security 12% that we just talked about. So if you're making over 400,000, they're really trying to focus on, making you foot the bill for any tax budget burdens that the government's going to run into. Capital, it also caps itemized deductions to 28% of your adjusted gross income, which is still a pretty high number. I don't think that would impact a lot of people. This is the other area that probably will. Again, we're in a warning level high area here for this income tax. So what it says is capital gains taxed at ordinary income rates on income over 1 million. So remember in that red and blue graph, the 20% capital gains rate to jump to 39.6 is what they're talking about here if you have income over 1 million. So if you have income over 1 million, you might say, well, you're rich, you're making over $1 million a year. But a lot of times that's not the case for people. You might only have 1 year of that kind of income as you sell a business or get stock options. I mean, there's lots of things that happens, and that's going to make your planning impacted, as well as the people that make, $1 million plus in income every year. The last thing is something that hasn't been discussed as much. I think it would be very complicated to do it, but just in case you hear about it, they have mentioned removing a deduction for retirement plan contributions and just adding a tax credit. So basically right now, if you contributed $10,000 to your 401k, and let's say you were in the 20% marginal tax rate, that $10,000 contribution put $2,000 back into your pocket. And if they switch it to a credit, they can actually incentivize the lower income that might be in a 12% bracket to basically get more of a benefit for saving money. And again, the flip side of that is penalizing people that might be in the 32%, 35% bracket and saying, hey, we're not going to give you a 35% write-off. We're going to give you a credit, which is equivalent to 20%. So I'm glad it's something that hasn't been picked up again, but it was discussed for a little bit. So kind of going through these, what's the big deal on this? Again, I covered this a little bit before, but if you increase the rates over 400,000, it might be actually jumping about 8% for some people on how much they're paying. And then on top of that, the 12% Social Security. So basically a 20% jump in taxes if you're over $400,000 per year. And then again, the same example of ordinary income. So capital gains rates, so that higher 40% rate on any income over $1 million, even if you've already paid taxes on that property. So this example here, if you inherited property with $1 million in growth and you received it with that carryover basis that we talked about. So you inherited what your parents paid it for. You didn't get a step up. Well, when you go to sell it, 39.6% is how much is due in taxes on the growth. So that's $400,000 due immediately, as opposed to the current rule, which says you don't owe anything. You get a full step up in basis. So this would be pretty significant for a lot of people. And same here, if you own a business, sell it to fund your retirement and make over $1 million in profit, you're going to owe almost 20% more in taxes. So what should I do is kind of the next question, because I want to make sure we've got some takeaways that are a little bit more global and hopefully ones that you can apply to your situation. So number one is the policies are targeting the wealthy and rich, but everyday people can be caught in it. So even though you hear on the news, oh, we're only talking about the wealthy, only talking about the rich. Maybe that was the intent. Maybe that was not the intent. It's for you to decide. But I will say that it's very common in what has been outlined that just everyday people like you and me and our loved ones will be impacted by this on some level. So key takeaway number 2 is there will be planning opportunities to minimize potential tax increases. And so we're going to go through what some of those look like. But just to quote one of my favorite characters in The Matrix called the Keymaker, who is always saying, another way. There's always another way. I want to make sure we're looking at and saying, hey, what are the other ways? What should we be considering or just putting a thought in the back of your mind about? So let's start with excise taxes, sales taxes, basically. No issues are on the table here that's not being talked about. So we're going to count this one a win. We're just going to say no potential approach is needed because we're not, doing anything here. Now, that being said, there are plenty of ways to look at reducing your sales tax impact. And there's actually some articles I wrote on this. So take a look at my website for more on that as well. Estate and gift taxes. So this was one of those big risk, areas, high risk. So if the federal exclusion goes from $11.7 million to $3.5 million, this is the issue. The other issue here is what if the step up in basis is eliminated and it's no longer that you get to inherit things free and clear, but you have to pay taxes either when you sell it or immediately. So here are some tactical potential approaches at looking at this. So first of all, reduce your estate size. $3.5 million in the future. If you have $3.5 million in a pre-taxed IRA, that is different than having $3.5 million in a Roth IRA. So one has all those taxes still built into it. The other one has all the taxes washed out of it. So I would prefer to have as much in Roth so that way you're already kind of compacted in what you're able to pass, tax-free in the future. So that's one option, is reduce your estate size by doing that. Another one is gifting while alive. So if you get to the point in your retirement where you're comfortable, your numbers make sense, and you're going to be passing on gifts to your kids or grandkids in the future, consider doing those gifts while you are alive. There's the federal annual exemption amount currently at $15,000 per person. So if you wanted to, you could give up to $15,000 free and clear. And even in this change, giving up to $10,000 could be an option. So there's other gifting areas that we can always talk about in your particular situation, but think about, doing that and having a living gift as opposed to just a gift upon death. Third option is utilizing trusts or life insurance. So this is the most common way to get assets out of your estate and into a different bucket, is using a trust, specifically an irrevocable trust, which is where you basically move it from your tax ID as an individual into a trust with a trust tax ID. This is a really complicated area of estate planning. So you definitely want to have an attorney to walk you, through that, because those trusts are a lot more burdensome to upkeep, but that is a very common way. And coupling that either directly or indirectly is using life insurance. So you could consider, depending on, health, age, all those types of examples, putting a life insurance policy with the intention, a guaranteed renewable term life policy, for example, in a trust, funding that. And then when you pass away, all the money goes into the trust and it bypasses your estate. So that's another common way to go about estate planning and getting around essentially those $3.5 million exclusion limits. So the last thing is reducing appreciated assets. So if we're worried about the step up in basis going away, that example of, you had a $150,000 stock account, it's now $600,000. Well, along the way, let's try to be more proactive at washing out those gains. There's ways where you could, in stocks, for example, sell the ones that are up and the ones that are down at the same time, eliminate some of those losses and gains, and washing out the basis. So that's one way to do it on the investment side. That's pretty common. On the real estate side, it's a little bit more complicated because you're holding on to an asset. Maybe you purchased it for $150. It's now worth $600. Consider at the right times, again, selling it, realizing the gains, and then purchasing other properties without doing an exchange necessarily for a 1035 exchange or 1031 exchange. The other option is if you did do an exchange and you purchased two other properties, it reduces the gains in each property, which makes it easier to sell and not pay as much on one big chunk in the future. So those would be some ways to reduce appreciated assets just for estate and gift tax conversation. So in other webinars I've done in the past, I looked at where is the average net worth. And if you haven't looked at some of those other webinars, please feel free to look at the other videos. They're all on YouTube. But the average net worth in the United States from highest to lowest is right in front of you. So rental property equity is the #1 area where net worth is being held. Annuities and trusts after that, and then stocks and mutual funds, followed by equity in one's own home, and then retirement accounts. So if you figure that rental property equity is the #1 area of holding, there's a good chance that that's where the government's going to focus some of this to say, hey, how do we basically keep that from being held away from us and then people not paying taxes on it? And that's where a lot of this, I feel like, is coming from, is, in small rooms, people saying, okay, if this particular couple had this property and we want to get to it, how do we go about it? And that's what's really coming out with this cost basis, carryover cost basis, and taxing capital gains at higher rates. It's all getting at stuff like rental property equity. So also, again, estate planning article that I have on my website is 3 ways to avoid federal estate taxes. If you haven't checked it out, under resources, constantly posting things. So take a look at retirementplanningfinancialadvisor.com for some things like that in the future. Corporate income taxes. So this is talking about the 28% tax rate that's proposed to go to, as opposed to 21% now. So as I mentioned before, we're talking about a small number of companies. Consider changing your corporate structure would be one idea. If you own one of these companies, look at the cost and the implications of going to an S Corp or an LLC. But then on top of that, reevaluate your write-offs, because a lot of times C Corps have different write-off rules with S Corps, and you might consider utilizing more of those things in those fringe benefits that are allowed to be written off on the C Corp side. So that's something you'll definitely want to work with your CPA on, or talk to me and I'll be happy to get you to one that knows that stuff. So payroll taxes. Main issue here is, again, the over 400,000. So they're just saying if you're making over 400,000, we're going to get you with that 12% Social Security tax again. And that is going to impact both people and companies, because if you have employees that are making over that, you're paying half of that as well. You're paying, 6% higher costs just to have that employee around. So here's some potential approaches if this were to happen. So first and foremost, using retirement accounts, max them out, get as much into there as possible. So that's always going to be a good option. Consider using a C Corp. If you're the owner of the company, what you could consider doing is switching to a C Corp, which means that you can set your salary at an amount that's under 400,000. You can set, other people's salaries under that, and just issue basically dividends out for any income that comes. So that's a way to keep out off of the payroll side for that income. And then there's things like split dollar insurance policies, which are a little bit more, a little bit rarer, a little bit more specific, but it's a way that a company can basically pay for give a bonus or some sort of compensation to an employee, and then end up having a large write-off for that over time by basically forgiving the gift of the insurance. So it's kind of specific, but my point is there are very unique ways that could come about that could help in specific situations should this come through. The next area here is looking at income taxes. So again, the main issue is if you're making over $400,000, you're going to be taxed more. The bracket's going to be going up. Probably we saw that coming for a while now. The bigger issue is the capital gains tax. That one will impact many, many people, from the lowest income to the highest income. So what can you do to basically approach this? So number one, again, use your retirement accounts. They have, they give you a deduction or you're getting it in a Roth. Either way can be beneficial. And selling property before large gains accumulate is a big part of this. So right now we're in a massively inflated real estate market. Taking this opportunity to sell a property that's at a large gain, even if you use it and buy into something else that's also, priced overvalued, that can be a way to basically shelter gains because you're selling high, but you're also buying high. So if the value of that property comes down in the future, well, it's just going to reduce your gains as well. So that could be something to consider, is just don't get so locked into owning property because it could come to bite you if they change this law. And then if you're a business owner, you look at using a multi-year buyout agreement. So instead of just a lump sum, hey, here's a sale, turning it over to private equity or a partner company that wants to acquire you, looking at a multi-year buyout will make a lot of sense because you can receive the funds over a period of time and they can be taxed at a more advantageous rate. So key takeaway number 3 is, rising taxes will always be a looming threat. And I think if we look historically and go back to those higher rates, 1947, these were some of the times where those rates were astronomically high. And I actually cut off this bracket at 59% because it kept going up into the 90s. And this shows you here on the left, this is if we took 1947 tax rates for percentages and applied them to today's dollars, which are in today's brackets over here on the right. But if we just took today's dollars with inflation that has occurred, which is 3.63% since 1947, you'll see that if you made over 100,000, you were already in a 34% tax bracket at that point. If you made over 200,000, there's a good chance that you were at a 50% bracket. Comparatively today, if you make over 600,000, you're still, capped out at 37%. So keep in mind, historically, we are in a low tax bracket. So that's why I'm always talking to people about let's use Roths. Let's utilize Roth contributions, conversions, whatever it is. Let's lock in these taxes because there's a good chance they will go up at some point just because historically we've seen it. So again, things we can all do, taxes continue to rise. How should we approach it? So like I just said, utilize Roth accounts, utilize Roth IRAs, utilize Roth 401ks. You can do conversions. If you're retired, we might have already had conversations about this, converting some IRA funds into Roth IRAs, locking in those taxes. Makes a lot of sense for a lot of people. Of course, your situation may be different, so always get that personalized advice. But utilize Roth accounts and utilize taxable accounts is the other thing. If rates do go up, so let's say you're in a 50% bracket, or you're looking, down the barrel of 50% bracket in the future, you could consider saying, hey, I'm at a 36% now. I'm going to pay the taxes. I'm not going to use the pre-tax 401k. I'm just going to get my match. I'm going to put the rest in a taxable account. because I'll pay the taxes, but at least I've locked in what I just got out at a 36% rate when I'm afraid it's going to go to 50. So if you're worried about being locked in and having too many of your eggs in the basket where the government can pull the strings on ordinary income rates, consider using taxable accounts. I'm a big fan. They're the only account that you're able to generate a deduction for clients through losses. So that's a great option as well. And last is just, having conversations. Have conversations with your kids if you're going to be passing on assets to figure out, does it make sense to gift now? Does it make sense to not gift now? All those kinds of things. With your parents, so if you are expecting an inheritance, you should be proactively asking, and not in a way where you have an expectation, but just saying, hey, we want to make sure that your wishes are being honored, your legacy is being honored, and the government's not going to take half of that just because we didn't have a conversation and plan a little bit beforehand. So having conversations is really important in life. And in that note, I'm happy to have a conversation with any of you about your specific situation. Please feel free to reach out. And if you have any questions, I'll take them now if you want to send them in the Q&A box. But otherwise, feel free to shoot me an email, a text, and would love to get together.